All right. Hey, everyone. Welcome back. And if you're here with us today, I think it's safe to say you're serious about growing your wealth, right? Making that money work harder for you, whether it's dipping your toes into the stock market or finding those smarter ways to really build a solid financial future.
Yeah, you got it. And especially in today's world, right? With headlines that can send stock prices up and down in the blink of an eye.
Yeah.
It's more important than ever to cut through all that noise.
Oh, yeah, for sure.
And, understand what a company is really worth, like at its core. And that's where fundamental analysis comes in.
Yeah. Fundamental analysis. That's what we're diving deep into today. And it's a game changer, honestly.
That really is.
When it comes to investing, so think of it like this. We're looking under the hood, really dissecting a company's financial health, their revenues, their profits, their debts, everything.
Yep. All of that.
And we're also looking at the bigger economic picture, to figure out the true value of that company.
Right. Because it's not just about the numbers on the balance sheet.
Exactly.
It's about understanding the whole story, the context.
It's about the whole story. Yeah. And that's what we're going to unpack today. Give you those tools, those fundamental analysis principles that will help you make those smarter investing decisions.
Exactly. Equip you with the knowledge to be a more confident investor for the long haul.
Yeah, for the long haul, that's the key. And, the material we've gone through, it's really in-depth, gives us a solid foundation.
Absolutely. A great starting point for this conversation.
So with that said, let's jump right in. The first thing is, what are those analysts really trying to do with this fundamental analysis stuff?
So at its heart, they're trying to see if a stock's price, the one you see flashing on your screen,
right,
really reflects what that company is actually worth based on its business, its fundamentals.
They're trying to find those hidden gems or maybe those overhyped stocks.
Yeah, exactly. Are they undervalued or overvalued?
Right. And that brings us to those terms, right? Undervalued, overvalued.
Correct.
What are we talking about here?
So if your analysis shows that a company's true worth, what we call fair market value, is higher than its current stock price, that's a potential buy, right? You're essentially getting a bargain.
A bargain basement stock.
Exactly. On the flip side, if the fair value is lower than the market price, well, then that stock might be overvalued. It's like paying a premium for something that's not really worth that much.
You're getting ripped off.
Yeah, potentially.
Yeah.
And that's when you might want to hold off or even consider selling if you already own it.
Makes sense. So it's like your own informed opinion versus what the market's saying at that moment.
That's a great way to put it.
Because the market can be fickle.
Oh, absolutely. Driven by emotions and short-term trends.
Yeah, for sure. So how does this fundamental analysis, differ from technical analysis? Because I hear that term thrown around a lot too.
So with fundamental analysis, we're digging deep into a company's financials, right? Their earnings, their assets, their debts, trying to understand the underlying business.
Right, the nuts and bolts.
Exactly. But with technical analysis, it's a different ballgame. They're looking at charts, historical price patterns, trading volumes, trying to predict future price movements based on past trends.
So it's more about timing the market, those short-term swings.
Yeah, you could say that it's a bit more speculative.
Gotcha. So one's about the long game, the other's about the quick play.
Pretty much.
Okay, that clarifies it. So let's get back to fundamental analysis. What are those key areas we're really focusing on when we're trying to assess a company?
So we're looking at a few crucial things. First off, revenue growth. Is it going up consistently? Is it slowing down or maybe even declining? That tells you a lot about the demand for their products or services, right?
Right. Are they growing? Are they shrinking?
Exactly.
Are they stagnant?
Then we look at profitability.
Okay.
How much money are they actually making from their sales after covering all their expenses?
So it's not just about sales, it's about efficiency too.
Yeah, exactly. Are they a well-oiled machine or are they leaking money somewhere?
And then there's competitive advantages, right?
Oh, absolutely. That's what sets a company apart from the crowd,
Right.
What makes them unique and hard to copy? Do they have a killer brand like a Coca-Cola or maybe a groundbreaking technology that others just can't replicate? Think of it like a moat around their business, protecting their profits.
Like a castle moat.
Exactly.
Keeping those competitors at bay.
And then, of course, we can't forget about management.
Yeah.
The people running the show, are they experienced? Do they have a good track record of making smart decisions?
Are they leading the company in the right direction?
That's key. And then we zoom out a bit and consider those macroeconomic factors,
Yes.
the overall health of the economy, interest rates, inflation, things that can impact a company's performance.
Right, because a company can be amazing, but if the economy tanks, well...
It's going to have an effect for sure.
Yeah. So it's all connected. It's a big picture view.
Absolutely. And by looking at all of these factors, we can get a much clearer picture of a company's potential for long-term growth and profitability.
Okay, this all sounds super valuable, but where do we actually find all this information? It feels a bit overwhelming, like, do we need some fancy Wall Street terminal?
Well, not necessarily. There are actually a lot of resources available to everyday investors.
Oh, good.
One of the most important places to start is the SEC filings.
Yeah.
The Securities and Exchange Commission.
Okay.
These are public documents that companies are required to file, and they're a goldmine of information.
So what kind of documents are we talking about?
So you've got the 10K, that's the company's annual report, their big yearly story.
Okay.
Then there's the 10Q, which is a quarterly update, so you're getting more frequent snapshots.
Gotcha.
And then there's the 8K. This one's like a news flash. It's for any major events that investors need to know about right away, like a merger or a big CEO change.
Keeping us in the loop.
Exactly. And the best part is you can access all of these filings for free on the SEC's website through their EDGO database.
EDGR, I've heard of that.
Yeah, it's pretty user-friendly once you get the hang of it.
So we can get the straight from the source information right there.
Yeah, right from the horse's mouth.
Okay, so that's a good starting point. What else should we be looking at?
Well, the company's own investor relations website is another great resource.
Okay.
They usually have a ton of stuff like their financial statements, earnings, releases, presentations, transcripts of their earnings calls, where the management discusses their performance with analysts.
So it's like getting the inside scoop.
Yeah, you can really get a feel for the company's strategy and how they're thinking about the future.
Okay, great. And what about those financial websites, like Yahoo Finance, Google Finance, those ones?
Yeah, those are super helpful too. They compile a lot of the key data you need.
Okay.
Like stock prices, charts, news analyst ratings, key financial ratios, all in one place, easy to access and understand.
So it's kind of like a one-stop shop for the basics.
Exactly. A good place to get an overview, and then you can dig deeper from there.
Makes sense. And you mentioned broker research reports.
Yeah, if you have a brokerage account, they often provide research reports on companies with their own analysis and recommendations, which can be helpful to see what the professionals are thinking.
All right, so we've got the SEC filings, company websites, financial platforms. What about for those of us who, want to really go deep down the rabbit hole?
Oh, well, if you're ready to get serious, there are these professional-grade financial data providers like Bloomberg, FactSet, Morningstar.
Yeah, I've heard of those.
They offer an insane amount of data and super sophisticated analysis tools, but they usually come with a hefty price tag.
So maybe not for the casual investor.
Right. Probably not worth it unless you're managing a huge portfolio or working in finance.
Makes sense. And then we also have industry trade journals, right?
Oh, yeah. Those can be really valuable for understanding the specific trends and challenges in a particular industry. What's hot, what's not.
Gives you that industry-specific context.
Exactly.
Okay. So we've got a whole arsenal of resources here. It's about piecing together the puzzle from different sources.
Right. And it's important to use multiple sources to get a well-rounded view.
Yeah.
Not just relying on one single perspective.
And to be aware of potential biases.
Oh, absolutely. Every source has its own angle.
Okay, so let's talk about those financial statements. We've mentioned them a few times, but let's break them down one by one, starting with the income statement. What's the story it's telling us?
So the income statement, it's like a report card on a company's performance over a certain period, like a quarter or a year.
Okay.
Shows how much money they brought in their revenue, how much it costs them to make their products or deliver their services, and ultimately how much profit or loss they had at the end of the day.
So it's revenue minus expenses equals profit, or in some cases loss.
Exactly. You got it.
And what about those profit margins we talked about earlier? Where do they fit in?
So profit margins are a way to express a company's profitability as a percentage of their revenue.
So it's like a measure of efficiency.
Exactly. For example, if a company has a net profit margin of 10%, that means for every dollar of sales, they keep 10 cents as profit after all those expenses are paid.
So the higher the margin, the better, generally speaking.
Generally, yeah. It usually means they're either really good at controlling their costs or they have strong pricing power in the market. They can charge a premium for their products or services.
That makes sense. Okay, so we've covered the income statement. Let's move on to the balance sheet. What's this one all about?
So the balance sheet, it's like a snapshot of a company's financial position at a specific point in time.
Okay.
It shows what they own their assets,
all right,
what they owe their liabilities, and what's left over for the owners, the shareholders' equity.
Okay, so it's assets, liabilities, equity.
Yeah, and there's a fundamental accounting equation that always holds true: assets equals liabilities plus shareholders' equity.
So everything has to balance out, hence the name balance sheet.
Right, exactly.
And this gives us a sense of their financial stability, right?
Right. Yeah, it shows whether a company has enough assets to cover its debts and how much of the company is actually owned by the investors versus being financed by debt.
So a heavily indebted company might be riskier.
Yeah, potentially. Especially if their earnings take a hit, they could struggle to make those debt payments.
Gotcha. So the balance sheet gives us that big picture of their financial health.
Yeah, you could say that.
Okay. And then we have the third financial statement, the statement of cash flows. How's this one different?
So while the income statement focuses on profits and the balance sheet is like a snapshot in time, the statement of cash flows tracks the actual movement of cash, both coming in and going out of the company.
Okay. So it's all about that cash flow.
Exactly. It shows how much cash the company generated from its core operations, how much they invested in things like property and equipment, and how much they raised or paid back in financing activities like loans or issuing stock.
So a company might look profitable on paper, but if they're not actually generating cash, that's a red flag.
Yeah, that's a big one. And that's why the statement of cash flows is so important. It gives you a more realistic view of a company's financial health.
Because cash is king, right?
It really is. At the end of the day, you need cash to run your business, pay your bills, and invest for growth.
Makes sense. So we've covered the three main financial statements, the income statement, balance sheet, and statement of cash flows. These are really the foundation of fundamental analysis.
Absolutely. They're the building blocks.
But it's not just about the numbers, right? There's also that qualitative side, the stuff that's harder to measure.
Oh, yeah. That's a crucial part of the puzzle, too. It's about understanding the company beyond just the numbers.
So we're talking about things like the quality of their management team, the strength of their brand, their competitive advantages, those kind of things.
Exactly. Those are all qualitative factors that can have a huge impact on a company's long-term success.
So one's the hard data and the other is more about the story behind the numbers.
You could say that, and they both matter. You need both sides of the coin to get a complete picture.
All right, so let's dive into those qualitative factors a bit more. We talked about the business model earlier. Why is it so important to really understand how a company makes money?
Because it helps you see the bigger picture.
Yeah.
What's their core strategy? How do they generate revenue? How sustainable is it? How scalable is it?
Right, because a company might have a great product, but if their business model is flawed,
yeah, it's not going to matter in the long run.
They're not going to be successful.
And then there's the competitive advantage, that moat we talked about earlier. That's what gives a company an edge over its rivals.
Yeah, and those moats can come in different forms, right?
Oh, yeah, absolutely. It could be a strong brand like Apple or Nike, where people are willing to pay a premium just for the name.
Right.
It could be a cost advantage where they can produce things more cheaply than their competitors, maybe because of their scale or their technology.
Or maybe they have some unique technology or patent.
Yeah, proprietary technology, that's a big one. It gives them a huge advantage that's hard to copy.
So as investors, we're looking for those companies with wide, deep moats.
Exactly. Because they're more likely to stay ahead of the game and maintain their profitability.
Now, management, that seems like a really tricky one to assess. As outside investors, how can we judge the quality of a company's leadership?
Well, you're right. It's not always easy, but you can do some digging. Look at the experience and track record of the CEO and the other top executives.
Okay.
Have they been successful in previous roles? Do they have a clear vision for the company's future? Read their statements and earnings calls and investor presentations, see how they communicate and think.
Are they inspiring? Are they transparent?
And look for any red flags too, like excessive executive compensation that's not tied to performance or maybe a history of ethical lapses.
Yeah, that would definitely be a concern.
Absolutely. You want to invest in companies that are well managed with leaders who have integrity and are aligned with the interests of shareholders.
Makes sense. All right. And then there's corporate governance. What's that all about and why should we care?
So corporate governance is all about how a company is run. The rules, the practices, the processes by which it's directed and controlled.
So it's about making sure the company is being run responsibly and ethically.
Exactly. And that it's acting in the best interests of its shareholders.
Okay.
Things to look at here are the composition of the board of directors. Are they independent? Are they diverse? Do they have the right expertise?
Right.
Also, how transparent is the company? Are they open about their financials and their operations? Do they treat their employees fairly?
Yeah, those are all good signs.
Absolutely.
All right, and then there's those broader industry trends, right?
Oh, yeah. You got to look at the big picture, too. Is the industry that company operates in growing or shrinking? Is it facing any major headwinds or tailwinds?
Right, because a great company in a dying industry
Might not be such a great investment.
Yeah, so it's all about understanding the context.
Exactly.
And then finally, stakeholder satisfaction. This one might seem a bit less obvious. Why should we care about how a company treats its employees, its customers, its suppliers?
Well, because a company that treats its stakeholders well is more likely to be successful in the long run.
Okay.
Happy employees are more productive, and innovative, satisfied customers are more loyal and likely to recommend the company, and strong relationships with suppliers can lead to better terms and a more reliable supply chain.
So it's not just about the bottom line, it's about building a sustainable business.
Exactly. It's about creating value for all stakeholders, not just shareholders.
Makes sense. So we've covered a lot of ground here on the qualitative side. Now let's get back to those quantitative factors, those financial ratios. Can you give us a crash course on the key categories and what to look for?
Yeah, definitely. So we've got 5 main categories of ratios: profitability, liquidity, solvency, efficiency, and valuation.
Okay. Let's start with profitability.
So profitability ratios, they tell us how good a company is at generating profits from its operations.
So are they making money? Are they making a lot of money?
Yeah. Exactly. Some key ratios here are gross profit margin, operating profit margin, and net profit margin. They basically show how much profit is left over after different types of expenses are deducted.
So higher is generally better?
Yeah, generally speaking, it means the company is efficient and can turn a good chunk of its revenue into actual profit.
And then there's return on assets, ROA, and return on equity, ROE.
Those are important ones too.
Huh.
ROA tells you how effectively a company is using its assets to generate profit, and ROE shows how much profit they're making for every dollar of shareholder equity.
So it's like a measure of how well they're using the investor's money.
Yeah, exactly. And a high ROE is usually a good sign. It means they're creating value for their shareholders.
All right, what about liquidity, those ratios? What are those telling us?
Liquidity ratios are all about a company's ability to pay its short-term debts.
Yeah.
You know, can they meet their immediate obligations without running into trouble?
So it's about their short-term financial health.
Exactly. The main ratios here are the current ratio and the quick ratio. They basically compare a company's short-term assets, like cash and receivables, to its short-term liabilities, like payables and short-term debt.
So a higher ratio means they're in a better position to pay their bills.
Exactly. They've got that cushion, you know, just in case things get a little tight.
Okay, so that's liquidity. What about solvency?
So solvency ratios are similar, but they focus on the long-term debt obligations.
So it's their ability to stay afloat in the long run.
Exactly.
Okay.
Key ratios here are the debt-to-equity ratio and the debt-to-assets ratio. They show how much debt a company has compared to its equity and its assets.
So lower ratios are generally better here, right?
Yeah, it means the company is less reliant on borrowing and has a lower risk of defaulting on its loans.
Okay, that makes sense. And then we have efficiency ratios. What are those all about?
So efficiency ratios measure how effectively a company is using its assets to generate sales.
Okay.
Some common ones are the asset turnover ratio, inventory turnover ratio, and receivables turnover ratio.
So are we looking for higher or lower ratios here?
Generally, higher is better. It means the company is turning over its assets, quickly generating more sales with fewer resources.
So it's about making the most of what they have?
Exactly, maximizing their efficiency.
All right, and finally, those valuation ratios. These seem pretty crucial for figuring out if a stock is a good deal or not.
Yeah, they're all about assessing whether a stock's current market price is in line with its fundamentals. You know, is it overvalued or undervalued?
Okay, so what are the key ratios to watch here?
One of the most popular ones is the price to earnings ratio, the PE ratio.
Yeah, I've heard of that one.
It compares a company's stock price to its earnings per share.
So if a company has a high PE ratio, does that mean it's overvalued?
Well, it depends. You have to compare it to the company's historical PE, its industry average, the overall market.
Right.
You know, there's no magic number.
Right, it's all relative.
Exactly. A high PE could mean investors are expecting strong future earnings growth, or it can mean the stock is simply overhyped.
Gotcha. So we got to look at the context.
Always. And then you have other valuation ratios like price to book, PB, price to sales, PS, dividend yield. Each one gives you a different perspective on a company's valuation.
So it's about using these ratios in combination to get a holistic view.
Exactly. No single ratio tells the whole story.
Okay, so we've covered a ton of ground here on financial ratios. It's a lot to take in.
It is, but the more you practice, the more intuitive it becomes.
And remember, there are tons of resources available to help you calculate and interpret these ratios.
Yeah, don't be afraid to use those online tools and financial websites. They can make your life a lot easier.
All right, so just to recap, we've talked about fundamental analysis versus technical analysis. Can we just quickly go over those key differences again, just to make sure it's clear?
Yeah, sure. So fundamental analysis, it's all about understanding a company's intrinsic value. What's it really worth based on its financials, its business model, its management, its industry, all of that.
So it's a deeper dive.
Yeah, you could say that. And it's typically used for long-term investing, buying stocks and holding them for years potentially. Yeah.
Okay. And technical analysis?
Technical analysis is more about analyzing price trends and charts.
Okay.
Trying to predict short-term price movements. It's more about timing the market, getting in and out of trades quickly.
So it's a different approach, different goals.
Exactly.
Okay. Now, we've talked about all the amazing benefits of fundamental analysis, but it's important to acknowledge that it's not a perfect system, right? What are some of the limitations that we should be aware of?
Yeah, definitely. No investment strategy is foolproof. And fundamental analysis has its drawbacks too.
Okay, like what?
Well, for one, it can be pretty time consuming. You got to do a lot of research, digging through financial statements, reading industry reports and all that.
It's not a quick and easy thing.
Right. It takes effort and patience.
Okay. What else?
And fundamental analysis is based on historical data. So it can be a bit of a lagging indicator. The market might have already reacted to some news or trend by the time you see it reflected in the company's financials.
And it's not always a crystal ball.
Right. And past performance is never a guarantee of future results.
Yeah, we hear that all the time.
It's true, though.
Okay. What else should we keep in mind?
Well, the accuracy of fundamental analysis also depends on the quality of a company's financial reporting. Are they being transparent or are they using aggressive accounting practices?
So there's a bit of trust involved.
Yeah, you got to do your due diligence and make sure the numbers you're looking at are reliable.
And it can be hard to value intangible assets, right?
Oh, yeah. Things like brand reputation, intellectual property. Those can be really tough to quantify, but they can have a huge impact on a company's value.
Right. Like, how do you put a dollar value on Apple's brand?
Exactly. It's not easy.
Okay. So those are all important things to consider.
And also, fundamental analysis often relies on assumptions about the future. Like what will interest rates be? What will inflation be? What will the economy do?
And those are all unknowns.
Exactly. So there's always a degree of uncertainty.
Okay. So it's a powerful tool, but we got to use it wisely.
Absolutely. It's about understanding both its strengths and its limitations.
Now, the material we went through had a hypothetical example of a company called ABC Inc. Can we talk about that for a bit, just to see how these principles might play out in a real-world scenario?
Yeah, definitely. So in that simplified example, ABC Inc. was a company with a lot of positive signs. They had strong profitability ratios, meaning they were making good money.
Okay.
They had healthy liquidity, so they could cover their short-term debts. No problem.
Good.
Their debt levels were manageable,
Yeah.
so they weren't overly reliant on borrowing, and their valuation ratios suggested they were fairly priced, maybe even a bit undervalued.
So the numbers were looking good.
Yeah, and then on the qualitative side, they had some great things going for them too.
Like what?
They had a strong brand reputation, a solid management team, a growing industry. They were even paying attention to those ESG factors, environmental, social governance.
So they were ticking a lot of boxes.
They seemed like a pretty attractive investment overall, at least based on that initial analysis.
Right. But it's important to remember that was a simplified example.
Yeah, absolutely. In the real world, you'd want to dig much deeper, compare them to their competitors, really scrutinize their management team, understand the risks they face, all of that.
So it's a good starting point, but there's always more to the story.
Exactly.
Okay. So to wrap up this deep dive into fundamental analysis, what are those key takeaways that we should remember as we're navigating the world of investing?
So the main goal of fundamental analysis is to figure out if a company's stock is truly worth what the market is saying it's worth.
Okay.
And it involves looking at the big picture, the overall economy, the specific industry, and then zooming in on the company itself.
It's a multi-layered approach.
It is. And we use a variety of tools like financial statements, financial ratios, market data to help us assess a company's value.
And one key metric to keep an eye on is earnings per share, EPS, right?
Yeah, that's a big one. It tells you how much profit a company is making for each share of stock.
So the higher the EPS, the better, generally.
Generally, yeah, it's a good indicator of profitability.
Okay, so ultimately, fundamental analysis is about empowering ourselves as investors to make those informed decisions.
Exactly. It's about looking beyond the hype and understanding what's really driving a company's value.
It's about separating the signal from the noise.
That's a great way to put it, and focusing on the long-term potential.
And for those of us who are building our wealth, for the future, this is such a crucial skill to develop.
It really is. It can help you make smarter choices that align with your long-term goals.
All right. So before we wrap up, I want to leave you with a thought. We talked a lot about those non-financial factors, those qualitative aspects of a company.
Yeah.
Things like their commitment to innovation, their ethical practices, their brand loyalty, all that.
Yeah, those intangible things.
So my question to you is, which of those factors do you personally believe are the most critical for a company's long-term success?
Ooh, that's a good one.
And how would you go about singing those qualities, the ones that aren't so easy to measure?
Yeah, it's a real challenge, but it's a worthwhile one.
Because those factors can really make or break a company in the long run.
Absolutely.
So think about it, do your research, and use those insights to inform your investment decisions.
Great advice.
All right, that's all the time we have for today. Thanks for joining us on this deep dive into fundamental analysis.
No pleasure.
And remember, stay curious, keep learning, and keep building that wealth.
That's what it's all about.
We'll see you next time.